welcome to Wealthion. I'm Wealthion founder Adam Taggart. Last week saw a deluge of news, from Fed Chair Jerome Powell's public comments to several jobs reports, as well as new data on the housing market. So to get help in processing it all, at the week's end, I invited Mish Shedlock to join me on a Twitter space and hash through our thinking together. A rollicking and quite lengthy conversation ensued, including a fair amount of Q&A with those who listened live to the discussion, several of whom added valuable boots-on-the-ground intelligence to our discussion on the housing market. The overall conversation was substantive enough that I think you, our YouTube audience, will enjoy hearing it too. So we're making it available to you here now. Enjoy. Everybody, thanks so much for joining us. Thanks for, again, being patient through all the technical hurdles here. We got a lot to talk about here on the first day of December. Mike, thanks for jumping on here with me. And we got a long list here. We're going to talk Fed. We're going to talk inflation expectations. We're going to talk economy, specifically a slowing economy. You got a great piece out today on inventories that I want to get into. We're going to talk housing. We're going to talk jobs. And then before we wrap things up here, we're going to talk a little bit of karaoke, because I know you've got
also, I'm willing to talk about the GDP now. The the Atlanta Fed came out with a new forecast today. I can explain what's going on with that, and that'll at least be new material. Nothing that's I've written about yet, but something I'm planning to write about for tomorrow. So if you stick around, you'll get my thoughts before they're actually posted.
All right, great. And to steal a little bit of the punchline, there's a pretty dramatic decrease in the GDP now number today. Yeah,
I can explain why. I'll go.
Okay, I've got that noted down here too. Maybe we'll put that back into the economy part of the discussion. All right. Well, look, let's start with the drama yesterday, right, where we had Federal Reserve released some prepared statements. Market didn't react tremendously to them, but then Jerome Powell had his conference, got tossed a lot of softball questions as usual, and actually talked a pretty bearish game, except for one particular statement where he said, the time to moderate our rate hikes, the pace of our rate hikes, not the total amount of them, but the pace of them, maybe sooner than we initially thought. In fact, may start as soon as December. And man, the markets took that as a fluorescent green light.
Here's the exact quotes. I listened to this whole thing. This interview was like over an hour, and there was no transcript of the Q&A, so you had to at least listen to the last part of it. But in response to a question on risk management, Powell said, one risk management technique is to go slower and feel your way a little bit to what we think is the right level. And then he went on, my colleagues and I do not want to over-tighten because cutting rates is not something we want to do soon. That's why we're slowing down, and we're going to try and find what the right level is. That is when the markets took off, Adam.
And by taking off, I think in the last hour and a half of trading, the S&P was up 3% and the NASDAQ was up almost 5%.
Down, and that's a reversal. They were down a percent and a half, maybe 2. I'd have to check the chart to be exactly certain on that. So you add it all up, and I think it was like close to a 6% reversal or so on the NASDAQ. Don't quote me on that, but somewhere between 5 and 6%.
Right, so dramatic whiplash in the last hour and a half of trading. So, Mike, you and I were going back and forth on Twitter a little bit about this yesterday, but in many ways, I think this is striking you and I as the market really seeing what it wants to see, in the Fed's words, as opposed to what the Fed is really trying to say.
Yeah. I was reading through this, and I'm watching the market and reading what he said, and I went through and I said I played the entire transcript just to make sure that I was not missing anything. But my overall personal interpretation was that it was quite bearish. He goes, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. Thing that strikes me as being bearish. There's considerable uncertainty about what the rate will be, although we've made substantial progress raising our target to 3.75%, but he wanted to say there's more coming. It's just going to be slower. But the weird thing to me, Adam, is the market had already priced in slower. If you look at the CME Fed Watch data, there was only a 50 basis point expectation hike then. There was an expectation, the end of next year that these rate hikes were really going to slow. All he really did was reiterate what the market expectations were, and I believe what he's already said, and yet the market took off like, boom, wow.
Yeah, and so here's my big concern, right? Because Powell reiterated the challenges that we face, the fact that he's not going to back off until inflation's under control, so that's going to dictate everything. But he basically said, we're going to go as high as we've been guiding, and perhaps maybe even a little bit higher than we were expecting just a little while ago, and then we plan to hang out there, right? Like,
that's bearish, right?
It is not bullish for absolutely certain, right? and there's not much in there that's really new for a bull to really hang their hat on. So my big concern here, like I said, is the market is just desperate to hear some good news that it can latch onto and push this rally higher. My sense is that it is setting itself up for a big disappointment, because as I look at the probability forks of the probability tree here in front of us, one is that, okay, the Fed does what it says it's going to do. That, I think, is going to disappoint the market's hopes right now. The second point is that the second probability path is that the Fed does pivot, right? Something breaks, forcing the Fed to pivot before it gets inflation under control the way that Powell wants it to get to. I'm betting if that happens, it's going to have to be something pretty dire. And the reasons driving that pivot are not going to be bullish reasons.
Correct.
You might get your pivot, but it might not be the party you want it to be. So I am concerned that the markets are setting themselves up here for a future disappointment.
Yeah, and let's go back to nothing he said yesterday, but what he said. I'm gonna guess a month ago, or maybe it was at the meeting before that, where he's essentially saying what I said all the way back in February, actually, that the market was going to be in and out of recession. He said expect a long period of weak growth. Actually, that's the way I phrased it. I don't remember how he phrased it. Probably something along the lines of subpar growth or something. And that is exactly what's going to happen here if the Fed slows down, doesn't get this to reverse, and just says, okay, we're going to hang out here for a while at whatever their ultimate interest rate is. None of that is good, as I see it, for corporate profits, is it?
I don't think so.
So, that's what we're setting up here. For whatever reason, the market was ready to rally. And my best guess on this is it was technical, actually. Is that people were, loaded up in puts. The market started to rally. And then they unwind these puts, and that fuels the rally. That's what I think happened. I didn't look at any put call ratios. I don't think you can actually depend on them, because just you see the number of puts go up, you don't know whether people are buying puts or selling puts, and there's a complete difference here. Right. If someone is selling puts, that's bullish. If someone's buying puts, that's a bearish speculation. So when you look at all these put call ratios, what does it happen? The number of puts is up, but the number of put transactions is up, right? But were they bullish bets or bearish bets? And calls can be, someone outright buying calls. They can be covered calls. They can be selling calls. So, I don't put a lot of stock in these put call ratios, but I think something happened there where there was an overwhelming number of bullish bets, and then the market started to take off on essentially no news at all, and then people have to cover their puts. That's what I think happened.
Yeah. I mean, when you see the type of movement like we had, as I mentioned, with 3% in the S&P and 5% in NASDAQ, and you said they were actually bigger if you look at the few hours before when they were down, that's usually very symptomatic of a short squeeze, right? It's a bunch of people that were on the other side of the trade, and when the market moves that far, that fast, they're forced to get out because their faces are melting off.
All right, want to move on to what?
Well, I want to sort of use that as a segue into the economy side of the story.
Okay.
But before we do, let's make the bridge inflation. All right. Obviously that's what's driving Fed policy the most right now. That's what Jerome Powell is lashed himself to the wheel here over. It does look like inflation, CPI, has peaked. I think we can probably feel safe making that call now. And
I'm pretty certain. I thought that last month. So yeah, okay. I think it's pretty clear today.
Great. So we can perhaps make the declaration that the era of rising inflation is over. We
better be careful there. The era of rising year-over-year inflation is over.
Yeah. So, but what I'm trying to do is say we may be making the shift from rising inflation to disinflation at this point, right?
Yes. Well, a falling rate of inflation. Yes, absolutely.
Yeah. Okay. So I think we're more or less on that page, and I think that's going to drive the action for the next couple quarters. I have talked to some people who think that we may find ourselves in outright deflation at some point later in 2023, but let's hold off on that just for a minute.
That wouldn't surprise me at all, but okay.
Okay. So what I'm trying to flag here is that we very well may likely see a different future than the recent past, given this shift in trajectory here. So when the Fed pulls a lever, right, when it makes a rate hike, there is a delay between when the Fed does that and when that fully manifests in the economy, right, before we feel its full effects. And there's a lot of different estimations of how long that is, but roughly, they're kind of range between 6 to 12 months. So let's split the difference and say around 9 months, right? So it's like only now is the economy really beginning to start to feel the slowdown effects of the rate hikes that were made back in February, March, April, right?
Other than housing, yes.
Yeah. So my point is already CPI is starting to come down. We're beginning to see the economy slow and decelerate. We may see that really begin to pick up steam here as we start getting slammed into by those delayed shock waves of what the Fed has already done, when the Fed, meanwhile, will still be hiking for the foreseeable future for some period of time. So the question is, are you expecting to see an accelerating deceleration of the economy based on what I just talked about?
Yes, absolutely. Inventory data points to that. I think housing data points to that. Some of the things that came out yesterday, which I've not even posted about yet, trade data is suggesting that. I don't know, where do you want to start with that? I can. I've not posted this, so you're hearing my comments here kind of live before I've even put them down to paper.
Well, that's what's fun about these Twitter Spaces. Once we actually get them to work, is folks get some of this advanced insight. So let's start with the inventories, but real quick before we get there, let me just kind of put you on the spot as just total prognostication. So this is total guess, but where do you see CPI by June of next year?
I think it's going to be probably. It wouldn't surprise. I'll just give you a range. It wouldn't surprise me to see it at say 3% or 1%, and I think it's probably going to be somewhere in that range. And actually, the economy's falling apart, I believe, so fast that we could see lower. The problem here is the way they measure it. And I've talked about this many, many times in the past. And what the Fed really needs to do is incorporate, not necessarily into the CPI, but incorporate into the way they look at things, actual home prices. If you recall what happened in 2008, I think we're going to see it again, but not to the same level once housing prices, started to collapse, so much of the economy, was dependent, on that was the true measure. The Fed panicked. I mean, they cut interest rates at the fastest pace on record, back then. I think COVID actually, might have increased that, but from a lower, much lower level. And, the Fed went from 4% to 0 in just a matter of months. Quite shocking there. And it's all because they don't know that they don't consider asset bubbles and they don't consider home prices as part of inflation. If we did what I would like to do, and I've got a post planned on this, I've already written it up, several times already, but I'm going to try it again from a slightly different angle next time as to, what the Fed really should be looking at. And if you look at my Case Shiller post that I did today, and I've got another follow-up on that tomorrow, it just showed, the Fed was doing QE all the way, up through March of this year, actually, despite home prices just absolutely soaring. If we incorporate those numbers, on the downside, and home prices accelerate to the downside, we would have, at least in my way of thinking, negative CPI. It's not consumer prices because homes aren't a consumer expense, but negative price inflation. And I think that's what matters. I think that's what matters to the real economy, not the Fed's, perceived idea of consumer inflation. It's not consumer inflation that matters. This is where they missed the boat, Adam. Trying to get consumer inflation up to 2%. Inflation was soaring because they didn't put home prices in it. And they're likely to miss the boat in the other direction this time. This is where deflation comes in.
All right, great. And we're going to specifically get to housing in just a few minutes here. But all right, I appreciate you answering this because it's helpful, because I would say that the experts that I've been talking to, they're largely kind of bifurcating into two camps around inflation. One group saying, I think it's going to be trickier to bring under control than the Fed expects here, and it's going to be stubborn and coming down. Then there's another camp, which I would put you in. I'd also put folks like Jim Rickards and Stephanie Pomboy in there, where they say, no, there's so many disinflationary, deflationary forces pulling things down right now. And if you look at history, the CPI can, tip over like a drunken sailor, very quickly when we fall into, the type of recession that it looks like we might be having. So, it looks like you're saying, yeah, you're a bit more confident in saying that inflation is going to come down faster, maybe than
I think so. But we do have differences that I pointed out, and they're very important. And so we can talk about this and make predictions, but we really don't know, what's going to happen here on two fronts that are completely open. And those two fronts are deglobalization and decarbonization. Both of those are very inflationary. So that is the headwind, that the Fed is fighting. Now, most of the people just say, well, they just, they don't even list those reasons as reasons, why inflation might be stubbornly high. They just think that, there's too much money, too much of this, too much of that. Actually, money supply growth, M2, is collapsing like a rock. It's really stunning. But to balance that, we've got quantitative tightening. Okay, so there's all these contradictory forces at play here that we've not seen before. For the last 3 decades at least, the Fed has had a tailwind of globalization at its back. So, it could easily, depend on globalization, on outsourcing, on all of that stuff to, lower inflation over time. That's what it was fighting. Okay. Now it has a headwind of deglobalization and decarbonization, and we really don't know what Biden is likely to do on that latter front over the next 2 years. So those are the wild cards, and that's why I'm a little bit more hesitant than normal to go off on my normal big deflationary stance that has typified my position over the last decade.
Okay, I totally understand why, and maybe we can get into what we think is more likely to unfold. Just put our prognosticator hats on there. But first, let's go to your recent piece about inventories, which I take as a sense that it's just yet another bit of evidence that is strongly suggestive that the economy is barreling towards recession here. You've got some great charts in there that, since we're on audio only here, you'll have to speak to. But you're definitely seeing a spike in private inventories, correct?
Yeah, we're talking about non-government inventories, and my charts are real. And by real, I mean inflation adjusted. And I had a question from that, on Twitter regarding that, and I said, so I added a tweet, that my charts show real inflation adjusted inventories. The index year is 2012. Actually, doesn't matter what the index year is, but that's what they use on Fred, the St. Louis Fed download that many of you are aware of. So I download my data from Fred. I create my own charts, but it's kind of interesting. In 4 out of the last 6 recessions, you've had this a surge in inventories that continues all the way, to mid-recession on 4 out of 6, and then in the other 2, private inventories peaked just prior to or at the start of recession, but in coming out of recession in 2020, we have the biggest spike, just in terms of the angle. The rate of increase of inventories on the wholesale side, whereas retail, there was a spike, but nowhere near as big. So we have these massive wholesale inventories out there where they're probably paying for storage, because they expected to have this demand from the retail stores, and the retail stores are trying, actually, if you look at all the things that Target has said, Walmart has said, they're concerned about their inventories. So the inventories are piling up on the wholesale side. What can that possibly mean, other than huge price cuts are coming in the not too distant future, right? So that is very, very, actually that's deflationary. But again, we have all the all the forces, if you look at this in isolation, but you can't look at this in isolation, because we have, the policies of the Biden administration and other policies, that are in play here that somewhat counterbalance that. To what extent, we're all guessing, but at least we can identify the forces here correctly, Adam. At least I hope we can.
Yeah. Okay. So what we do know for sure is that inventories are building, and as you said, basically at the fastest pace in the data series here. So what we can't tell for sure, but I'd love to get your opinion on, is how much of that is due to, perhaps Jerome Powell's campaign of destroying demand that's beginning to bear fruit, right? Where people are just tightening their belts and they're spending less. Mm-hmm. And how much of that might be due to sort of a bullwhip effect, right? Where, we had all the disruptions to the supply chain, and when those tend to happen, you get the bullwhip effect where retailers and wholesalers order more than they need because they're trying to make up for the shortages they've had, and then they end up with way too much, right?
Both. I don't know how you put a percentage on those things, Adam, properly, but both of those are clearly in play, and also order cancellations are in play, right? So the Target, Walmart, Kohl's, all ordered way more stuff than they could sell. So then they thanks to the Fed policy, right? Cheap money. There's always a shortage at the top, right? There was an alleged shortage of houses in all the way through 2008, and then all of a sudden there's more houses than anyone knows what to do with, and that's a function of cheap money. That there's shortages at the top, and so based off of all these perceived shortages, both wholesale and retail side ordered inventory, but we've had the retail side cancel orders here now,
right,
and pay for it.
Sorry, that's a really good point. And sorry for everybody listening, I should have mentioned this at the beginning. Mike and I are going to bang through the topics we talked about. Then, if we have time, and I hope we will, Mike, we will take some Q&A from the audience. Just so
sure,
who are listening,
love live Q&A.
Yeah, so we'll do that, folks. If folks are interested in that, if you are, just give us a little hand wave here. There we go, a couple of 100%. Awesome. So one of the reasons why I asked that question about the bullwhip effect versus demand destruction, Mike, is because the bullwhip effect can be resolved more swiftly, right? If you ordered too much, well, you then order less in the future, and the inventory kind of equilibrates and matches with demand. Mm-hmm. If it's a declining demand problem, well, then that's a lot more secular, right? That's going to last for as long as it's going to last. Mm-hmm. One thing that
the reason why it's going to be secular here, or at least, I don't know, we need to define that term. Let's just say, for the immediate or the next few years, is the slowdown in housing leads to what? Leads to less need for furniture, less needs for cabinet, less need for lumber, less need for kitchen appliances, less need for refrigerators, less need for cabinets and woodwork, stoves, less landscaping, but most of those things I said were durable goods. And I think, that's what really got hit today in the ISM numbers here today. Stunning. But, services have been stubborn here, mainly rent. So you got two more forces at play in that, and this is where the Fed really misjudged things, and so did the retail trade. All of a sudden, we went from huge demand for goods, COVID, people buying houses in the suburbs, to all of a sudden absolute collapsing demand for for houses. But a surge in airplane travel, a surge in rent, so a big shift from that the Fed totally blew from service demand to goods demand.
Yeah, gosh, all great points. And again, we're going to get to housing in a minute. And it's a very important distinction you're making here, Mike, because a lot of people tend to think of housing as just sort of its own siloed industry. And it is so enmeshed with the rest of the retail economy, not even just the retail economy, that, weakness in that market spills over into a whole bunch of other sectors.
Including government, by the way. You have tax collection data. You have, when you go build a home, you need a permit. That permit fee goes to typically the city, and the taxes go typically to the county. So you have a fall off there in revenue that cities, counties, states have budgeted for, that's falling apart now, right?
Yeah, absolutely. Well, look, in addition to that, I wanted to just quickly talk about another piece of data you have in that inventories article of yours, which gives us more credence that this is more of a secular downturn than just an inventory bullwhip effect. And that is the increasing number of bankruptcies that we're seeing in the trucking and shipping sector, right? So these guys, they go out of business because they just don't have enough stuff to ship, right? So we've seen warnings issued by the CEOs of FedEx and of Maersk, right?
Mm-hmm.
Two massive multinational global shipping corporations. But we're also seeing just here in the US, individual, trucking fleets that are going out of business because they just don't have enough, to keep them in the green.
Yeah, Craig Fuller does a fantastic job on Twitter on the trucking industry.
Yeah, so I mean, to me though, that's just a really direct sense of like, okay, we can sit and pontificate all day long about whether this stuff is going to be short-lived or it's how bad it's going to be bad, it's not going to be bad. But when you see market players start dying on the vine, like one of the companies that's featured in the Freight Waves article that you featured here, is a trucking company that's been in business for 24 years.
Mm-hmm.
Right. So it's not, I know in the past 2 years, you had a lot of kind of, pop-up trucking companies, which largely are, a couple guys who buy a truck or two.
Right. Mm-hmm.
Right?
No, this was a legitimate firm here. And this gets back to a comment that I made earlier about, why this is going to be I still don't think it's going to be a deep recession. You and I might disagree on that, but it's going to be long or in and out of recession for a number of years. And the simple reason is housing is highly unlikely to recover here. And until housing recovers, you don't have the demand for durable goods. Housing doesn't make up that huge of a percentage of the GDP, per se. But, however, it's a cyclical component that tends to lead recessions and recoveries, right? So if we're not going to have a recovery in housing for a long time, and I don't believe we are, then you're going to have a slowdown that is going to last for a fairly long time. And again, this is another thing that I don't think the stock market is priced in for.
Yeah. Well, and again, I think we'll keep going back in this discussion to the main thesis of this whole talk, right? Which is the market setting itself up for disappointment here by being overly euphoric right now. There's another data point in your article where you talk about U.S. composite PMI,
Mm-hmm.
and it has turned negative for well, in the data series here, which is about 15 years old.
Mm-hmm.
It's only been negative twice. One was during the Great Financial Crisis.
Mm-hmm.
One was during, the COVID
Mm-hmm.
panic. So now we're back into negative territory there. As you say
that
here,
includes services, yeah. And the interesting thing here, and I've not figured this out, and I've talked about it, but not recently, is the divergence between the PMI and ISM. ISM is always seems to be way stronger than PMI. In theory, they are contacting, surveying the same industries. Why is one always weaker than the other? They finally got back in sync here with this latest ISM report that's now in contraction.
Right, exactly. Just want to underscore that. They're in sync, both saying the economy is contracting at this
Yes.
point.
Mm-hmm.
Yeah. So we have a lot of data here now that we just walked through that says, economy is continuing to contract, continuing to slow down. I think it's hard to make a super bullish case right now about the economy, unless, and we do have to keep some probability out here for this. There are some potential bullish triggers that could happen in 2023. A big one that a lot of folks are expecting, if they can get through their current civil unrest issues, is that China's going to reopen, right? And that's going to give a goosing to the global economy. The second is, some sort of negotiated settlement between Russia and the Ukraine.
Mm-hmm.
So we do have to be aware that there are certain things that in the midst of the secular trends you and I are talking about could kind of inject a sugar rush into the system here for a bit.
Exactly. And that's another reason why, you asked me what my target was here. I gave it as a range, but it wouldn't be surprising, the events, global events, what Biden does, what China does, can swing things easily in one direction or another over, even the range, the pretty wide range that I gave.
Right, and also in your range too, what would really depend. And I know I asked you to guess with lots of imperfect information here, Mish. Don't worry about it. You'll be back on the program, plenty of times. But it is, something really bad could break, like we talked about, right? There could be a forced Fed pivot, and the central bank policy response is also a big wild card here too, right? Right now, Powell is saying, "Hey, I want to hike higher and then sit there for a long time and see what happens." That's one set of scenarios plays out from after that. But if something really big breaks and all of a sudden the world central banks say, "Hey, we have to go into pandemic style rescue measures here," well, then everything changes from a calculation standpoint.
My base case scenario, by the way, is that something really big is going to break, but not necessarily in the manner or the timeline that most people sense it. They are going to over tighten, in my opinion, and it's actually conceivable to me that they already have.
Oh, that's what I was about to ask. Yeah. So.
But the problem is, and I think they understand it. They don't want to reignite another bubble. So that's a reason why they're going to be cautious, even though they're slowing the rates of hikes here. I don't think they're going to jump on the pivot very fast. And so, but this goes back to something you said right at the very beginning that I strongly agree with. When the Fed finally recognizes that it breaks something, hey, is that really a good thing for the stock market? So I think you hit the nail on the head on that one.
All right. Well, I sure hope we don't have to see the answer to that question, but I think odds are probably not bad that we will. To your point about something actually breaking and the Fed having to deviate from Powell's plan here.
But let's talk about that for a second, because what is likely to break. I personally don't think it's I don't know if we can morph into jobs here. I personally don't think it's going to be jobs. It's more likely to be a credit event somewhere, yeah. and it doesn't necessarily have to even be in the U.S. It could be in Japan, it could be in China, it could be in Europe. I think that's more likely to me. There's just too many openings. There's too many people retiring. So I don't think it's going to be jobs that causes a bust. Although, if we do see just like almost any uptick in unemployment, guess what? You're going to have people like Elizabeth Warren, AOC, everyone else hollering at the top of their lungs, at what the Fed's doing, and is that going to weigh on their minds and cause them to pivot earlier? I doubt it, but that's another. You have politics that is going to enter this for sure as well.
Well, absolutely. Let's hold off on jobs just for a second here and get back to the credit part. So, that is. Well, first off, on the jobs, the Fed has a dual mandate, right? And Powell, I think, has been uncharacteristically transparent in saying, you know what, if I got to sacrifice jobs for inflation right now, I'm going to do that.
That's right. He didn't say it like that. It was more polite, but you got the exact tone right there. That is his message, but he's just not saying it that way.
Yeah. Well, it's sort of like, and again, he's been refreshingly transparent. Hey, folks, getting inflation under control is going to cause pain for both corporate and regular America. That's as close as he's ever going to get to saying, I'm going to cause a recession.
Yes, exactly. In fact, he's still, talking about this. He's giving himself an out, but he's always given himself that out. But he's still talking about, a soft landing is possible, blah, blah, blah. He said that yesterday. But then he went on to say, history suggests that it's not very likely. It's not exact close, but that is very close to exactly what he said.
Yeah. So from reading what he's saying, I think he's willing for a period of time to throw jobs under the bus to get inflation under control. As
long as it's not a huge big collapse. He's got a lot to work with here because unemployment is at historic low levels here. So is a rise of 1% enough to trigger it? I don't know, but a 1% rise in unemployment would be a very, very weak, historically speaking, rise in unemployment, and I think that's quite possible.
Yeah, well, I do too, and we're gonna get to sort of our semi-dueling opinions on where we think unemployment could go. But yeah, it's at a historic lows. Looking at the data, there's a lot about the data I don't trust. I'm not even sure if Powell totally trusts it, but I think he is enjoying looking at this lagging data that says jobs are fine because it gives him a big fat green light to
Exactly.
tighten and hike the way.
Exactly. Exactly.
Right. So here's where I'm going. So that's the job side, but I think the bigger boogeyman for Powell, I mean, obviously inflation is the biggest one in the room right now, but the one that could potentially become even bigger would be a credit freeze, like you're talking about, where just people stop all of a sudden lending. The big players stop lending themselves, and the financial plumbing just ceases. And of course, that was the big concern back in 2008.
That did happen in 2008, and but the thing is, I don't think it'll be as sudden back then. It might creep up on them and then collapse. But we don't have the ninja loans, no income, no jobs, the liar loans, overstated income. We don't have as much speculation here now.
Unless you're looking at the auto loan market, but yes.
And the banks aren't as impacted here. The Fed put a lot of restrictions, on banks, on mortgages. So most of them aren't even touching these mortgages, and when they do, so most of them are going to Fannie and Freddie and FHA and all that. So it's taxpayers at risk here now, not the banks. That's a completely different issue.
Yeah. So the systemic risk is the systemic vulnerability is lower than it was heading into 2008, but it's not
much lower. It's not zero. It's much lower. It's definitely high and rising, but it is nothing like 2008.
Okay. But so two things. One, that if something were to lock up like that, that is something that could really force a Powell pivot. Again, that would not be a bullish, sign for the markets, but that's something that could happen. Now, this goes to your question of thinking that the Fed is over tightening and going to break something. You're saying, hey, the system's actually a lot stronger, but you are concerned. So I'm curious, sort of what candidates are out there that would make you think, okay, well, this could break enough to actually make the Fed have to change course?
I don't know. I'm thinking something more actually foreign. Actually, you can easily have some sort of, and I don't know what, but just a credit event in Japan or Europe or China would not surprise me at all. That parlays through. I can't define what that is. I've talked about this scenario many times of, what's the words that I use? I think we're going to have a credit event, is what I've said. And people say, well, what does that credit event look like? I don't know.
Right. But you're saying is it could be a contagion that comes from a foreign entity that creates a cascade that then and actually got it. Mm-hmm. Okay. And one thing for folks to really understand is, they might think, oh, well, if it's happening in another country, what do we matter, right? We're the U.S. The global financial system is just incredibly intertwined at this point, particularly when derivatives contracts come into play, but just major entities are, investors in all sorts of companies inside their nations, outside their nations. It's one of the reasons why when the UK had the recent gilt crisis, it impacted the treasury market. That same afternoon, right?
Yeah, I think something is going to break. I just don't think it's going to break as big as it did in 2008. Yeah. But I reserve caution on my butt, because we don't know, there can easily be something extremely major, happen in Europe or China or Japan that causes me to change my tune on that. That's all.
Okay. All right. Well, look, we got a couple more topics to go through. Then I want to get the Q&A. We may run a bit long here, folks, but I'm hoping that long is good for the folks that are enjoying this conversation.
Yeah, I'm willing to stay on as long as you want. So.
All right, great. All the way to the karaoke part, which is going to be awesome.
Oh my God, you're going to have me sing?
So at the end of the day, what I want listeners to get out of these interviews, Mike, is an understanding of what's happening, but I want to make it real for them. right? So it's like, okay, all these big things could be happening in the world of the global economy with the Fed, whatever. But what does that really mean to me in my life? So two main questions for you. One, what impact do you think this is going to have on the markets if the general trajectory we're talking about does indeed come to play next year? And then two, I want to talk about housing because housing is much more widely owned than stocks are. And what happens to housing impacts an awful lot of people. So,
Well, my base case, regardless of what happens, is the stock market decline is probably only half over. The you know, there's things that, you know, could make me change my mind about that, but if we bottom here, then my my number two alternate scenario is the stock market just doesn't go anywhere for the next 5 years. Either way is pretty bad. I'm not sure which one is worse, actually. The problem is pension funds are absolutely not priced for 0% gains for 5 years,
yeah.
whether we have a plunge now that recovers back to here, or we just, you know, basically go sideways for another 5 years and work it off. Neither one of those scenarios is very good, and my God, you know, heaven help us had the Democrats retained the House, because we would have had, you know, massive pension bailouts, you know, you know, to the main benefit of all the worst offenders, Illinois, New Jersey, right? You know the states. So that's one thing, you know, that happened. No matter which party you're on, hopefully you're just not in favor of more bailouts, you know, which were, you know, on the plate, you know, and you know, they're now no longer on the plate, I don't believe.
So I'm just going to mention real quickly, there's a lot to be said about pensions. I did just do a detailed interview with Ted Seidel, who is the recipient of the two largest whistleblower awards for pension fraud.
Wow.
He's a forensic accountant. It's a great discussion. If you want to learn more about the state of our pension system, or more appropriately put, the really depressingly unsecure state of our pension system, go listen to that interview with him. It'll keep you up at night. It's quite frightening how underfunded most of our pensions are, and really frightening is how poorly managed they are. So Ted sees pension bailouts and pension haircuts of benefits as unavoidable at this point. So to hear why, folks, go watch that. All right.
And, by the way, yeah, if they're not, you know, if we do bail out, let's talk about the beneficiary here. If those pensions are bailed out, look for a massive rise in gold. I'll just say that.
Okay. Well, you know, let's actually talk about gold real quickly for a second. And real quick before I do, I just want to mention, you know, it's been a rough year. At points during this year, it's been one of the worst years for the markets when you factor in the performance of both stocks and bonds together. So I'm not whitewashing that this hasn't been a painful year for a lot of people. But if you look at where the markets are right now, here at the end of the year, the S&P is down
14%, roughly,
less than 13%.
Okay.
In the start of the year. The Dow is hardly down at all.
Right.
Yeah, barely at all. So, you know, these are not like Armageddon or even like bear market, you know, stats right now. But a lot of people are talking about like, oh my God, this is the worst year ever, right? Thank God this is bear market over. And you know, I think we really have to say, hey, you know, like most bear markets, or like a true bear market, a bear market doesn't end with, you know, kind of
hopium.
Well, the opium that we're seeing in the markets right now. Yeah, exactly. And with people being like, oh, okay, is coast clear? Can I put my money back in now if I have money on the sidelines? A bear market ends when people are so just completely abused by how they've been treated that nobody wants to touch a stock again.
Mm-hmm.
right? They don't end, with everybody jumping back in and driving, the Nasdaq up 5%, in an hour and a half. So just to your general thesis that, hey, we may only be halfway through the decline of this bear market yet. Just sentiment wise, it seems very unlikely that we're at the end of this thing right now.
Right.
Okay, so you mentioned gold, and my guess is your gold thesis doesn't depend on a pension bailout for gold to do better from here, but it's certainly a potential trigger. But I just want to note that gold is finally back up against above $1,800 an ounce at this point. So we may have put in the bottom back there in the 1600s and are maybe back in a new up leg for the precious metal.
The gold had a really big day today. Actually, let me see if I can find it here. My stats might have been wiped out. Yeah, unfortunately, but yeah, I think it rose about $50 today or something. I don't have yesterday's price here in front of me, but
Okay.
big surge today. But anyway, I think gold is kind of. And let's just actually talk about gold as an indicator here. People think gold is an inflation hedge. I've always said gold is not an inflation hedge. Gold is a hedge primarily against central bank insanity. And I posted long-term charts of this that I've showed this. We had inflation all the way from 1980 to 2000, and gold fell from 850 all the way down to 250. Inflation every step of the way. What had happened is, primarily Volcker and then Greenspan, put faith, back in the Fed. Why did gold get hammered this year? Okay, with inflation soaring every step of the way. It's because people once again started believing that Powell was had things under control. Well, what's happening now? It's almost like gold is getting a sense that something is about ready to happen here. So, people look and say, well, the gold's a function of the dollar. Well, if you pull up a long-term chart of the gold and the dollar, you will find the U.S. dollar index and gold. You'll have, gold at 300, 500, 800, 1200 and 1800 with the U.S. dollar index all in the same place. That should tell you right there that gold's not really a function of dollar, except in the short term,
right,
where small day-to-day movements, are likely to be in line with the dollar. But over time, gold seems to be more of a function of faith in central banks. So it's interesting to me now to see this, huge surge in gold. Is it signaling here something? It might very well be, or it might just be, the market perception here, just like the stock market rally we had yesterday. Although gold rallied today, not yesterday. So it's kind of interesting. But that's how you think. That's how you should think about gold, and not as an inflation hedge. Clearly, it wasn't, and it's not now.
Okay. So a couple of quick things. One, it was $50 an ounce, up $50 an ounce today. So you were correct. I did just check the numbers. I think your point is important that gold and the dollar index, which really is a measurement of the dollar versus other fiat currencies,
Mm-hmm.
The long-term correlation isn't super strong.
Not at all.
The short-term correlation, though, as you said, generally is, and I would say it's been a big factor this year as the dollar has just powered higher month after month after month. It's been like a boot on the throat of gold and a bunch of other assets, not just gold only. But, the past couple of weeks, we have seen the dollar pull off a bit. And I've got to imagine that is playing some role here with gold's recovery.
Mm-hmm. Mm-hmm. Well, they're both, kind of symptoms here. I mean, they're related in that sense. But I don't know how to say it other than the long gold matters the dollar matters in direction but not amount. Okay, faith matters. Faith in the central bank is what is the driving force of big moves in gold up and down. And it was that faith, that faith that the Fed had, that was also causing the dollar to strengthen. Although there were other things, mainly Europe just being a bigger basket case than,
Right.
than the U.S. at the moment.
And Japan being an even worse one.
Yes. Mm-hmm.
Yeah. All right. So I'm going to pull it back into our last two topics before we get to the Q&A. So we've given a nod to both, but let's wade in deeply here because people really care about these two things: housing and then the jobs market. Okay. So housing, everything that you and I are looking at, because I know you and I, we talk about this a lot on Twitter and sometimes on the phone, is suggesting that the housing market is rolling over here and that the asset price bubble that we had in housing, I believe you agree with me, it was a bubble, has popped. And now we have begun the descent, and we're probably still in the quite early innings.
Very early.
And I believe there's lots and lots of macro reasons for that. But we can just take one of them that I think justifies a further material, substantial decrease in housing prices, and that's just mortgage rates alone. Mm-hmm. Right? They went from under 3%, not this summer, but the summer before. So what? A year and a half ago. They're now up near the 7% range. In California, on average, they're more like in the 8% range.
They've fallen the last couple of days. They're down to like 6.3, maybe 6.4, something like that. So they've fallen, and already, of course, we're getting the hopium talk here. If they fall any much further, it's going to revise housing. No.
No, that's like being really excited that CPI has dropped from 9.3 to 7.9, right?
Yeah.
Like, yeah, it's a lower CPI number. It's still horrendously high inflation, right? Yeah. So just mathematically, right, from a sub 3 to even a 6.3 or whatever you're saying,
yeah.
Right? Mm-hmm. There's a much more mathematical decline in prices that needs to happen just for that alone.
Absolutely.
And I think you and I can make,
and that's even without a recession coming, which,
right.
Right.
And you and I can make an argument that those mortgage rates may still go higher yet, just from the additional hiking that the Fed is going to do between now and whenever it stops.
More likely, when QT. This is another thing. The Fed has just like barely begun to sell mortgages, from its portfolio. So we still have QT that is going to enter into play. We really haven't even discussed here yet, right? By the way, it's 6.29%, dropped a third of a point today, 0.34% on 30-year mortgages.
All right, I'm sure that helps somebody who bought this week. Probably just a couple of disappointed people.
That's it. That's what we're talking about. Our homes really more affordable than that. Even coupled with actually pretty minuscule declines, that we've had, heading into recession, and just people's fears enter into play too. To tell you the truth, we've got a sentiment thing here. So, and also there's reports coming out that, and I think rents are probably going to at least stabilize or start falling. People will stop having this fear of, I gotta get in now, right? Because that's one of the things that was driving the housing market.
Right, huge FOMO, which is evaporated almost completely in the sense that housing's not going up in any market right now.
Right.
And to your point, so we're finally for the first time in years, right? We're seeing year-over-year price declines in a lot of the major metros. But they're still very small at this point in time, right? This is just getting started. Mm-hmm. Yeah. So we've had mortgage rates more than double, right? And we've had housing prices come off in most cases by low single digits so far, right? So from an affordability standpoint, it's the worst it's ever been right now, right?
Yeah. Yeah. It's still terrible.
Right. Which of course, and now we're getting into the post that you wrote today on the housing market. But that's why sales are drying up, transactions are drying up, right? We're kind of getting to this. We're in this interim stage here where there's almost sort of like like a Wild West, you know, shootout standoff between buyers and sellers. You know, sellers don't want to bring their prices down, but they're going to do everything they can before they actually start slashing prices.
Yeah.
And they're kind of telling each other, like, hey, let's just stand steady here, right? You know, nobody sell.
Yeah. Nobody sell.
Pull it off the market, right? And the buyers are just like, for the reasons I just mentioned, they're like, I'm not buying at these prices, right? And we know that unless magically the economy rides to their rescue, the sellers are going to lose this standoff.
Yes.
Right. Eventually, there's going to be houses that just have to sell for whatever reasons. People get divorced, they die, they have to move, you know, whatever, lose their job. And those transactions, because housing's priced at the margin, are what's going to reset the market values.
Yeah.
Yeah. All right. So this, you know, this has a big impact on consumers' wealth perception, right? So when we talk about the wealth effect and the negative wealth effect, I would posit that a declining housing market has a greater negative wealth effect dampening on the economy than a market correction, simply because so many more people own homes. It's their biggest asset. And when they realize, oh my gosh, I'm now worth 20 or 30% less than I was last year, I got to really start controlling my spending here.
Yeah, exactly. You got it. Bingo.
Okay. So again, I'm just making this really like tangible and practical and real for the listeners. Sounds like what you're saying is, hey, everybody buckle up. You know, if you're a homeowner, make a mental budgeting that your house might not be worth, you know, or may fall substantially in price. Obviously, it's going to depend on what market you live in terms of what the actual expense is. And then if you're an aspiring homeowner, it's, hey, you know, build your dry powder, and you might get some
now's a good time to wait. Yeah.
Patience.
Curiously, I'm building a home right now, but you know, it's we got the land a number of years ago. It's no mortgage. I wouldn't take out a mortgage here. So you know, so I'm not, you know, if you have if you can really afford it, you have a great reason to buy a home. Absolutely no concerns over a loss of a job. I'm self-employed. I'm not going anywhere. I'm not going to fire myself. I have no debt, you know. So, you know, if you have, you know, in that kind of setup, even still, you know, kind of, you know, look at your market. You know, do you really want to do this? Okay. So anyway, I just thought I'd, you know, say okay. That's what I'm saying. That's what I'm doing. But this is why, you know. Okay.
Yeah. One factor we haven't talked about is the institutional ownership of the residential real estate market. How much greater it is now than it was before.
Massive. And that was actually a part of the problem. Yes.
Yeah. And so there's the potential risk. I'm not going to say it's indeed going to happen, but I can certainly see it happening where these institutions that have bought tons and tons of properties, you know, some of them may get into trouble and have
BlackRock. I don't know. I just saw this today and never commented on it anywhere. But BlackRock is restricting people from pulling out.
Well, yeah. Let me make a quick correction. So it's Blackstone.
Blackstone, yes. I'm sorry.
And it's a commercial real estate fund, so it's not residential as we're talking.
Oh, okay.
But it is indicative, right? It's you've got massive real estate investors who are panicking, and they're trying to force redemptions on the Blackstone funds, and the Blackstone stepping in and saying, you know what, we're halting withdrawals for the time being.
Yeah.
You know, it's always a bad sign. Right. It's never a positive sign when somebody does that. And I think easily that could spill over into the institutions that own residential real estate, and probably could. Right. And so, of course, if you
probably
raising
will.
This, what I'm raising this is that's another factor here that could all of a sudden send prices down in a hurry in certain markets.
Yes, it could.
Got to play. There was a bunch of inventory that are saying, hey, we got to fire sale it all. Right. So one silver lining in all of this is I'm not remembering the data source off the top of my head, but I have seen some recent data to show that rents are beginning to come down year over year, and that's a very slow and sticky data set to move, because you have these, you know, rents basically are signed on a year-based lease, right? So you have to wait for the rents that were leases that were signed, 12 months ago to come up for renewal before you can really start seeing a change in the in rental prices. But as we begin to have more inventory flooding on the market, as housing that was held as an investment, or, maybe it was an Airbnb, it's not cash flowing as much, so they want to go to a long-term rental, or maybe it was a boomer that had two homes, and all of a sudden this one's not making me any money. I gotta start doing something with it to bring some money in. We may, and at the end of the day too, if housing prices come down, well, rents are really, house prices are supposed to be a function of the discounted cash flows of the rents, right? So mathematically, we would expect rents to go down. So where I'm going with all this is, renters might actually catch the first break they've had in a long time next year.
Yeah, it's going to be, well, catching a break here means, I don't think we're going to see huge declines in the price yet. If we do, that's a sign of yet another, problem area. Like one question always has been in the back of my mind, and I discuss it every time I do, these housing reports, where I look at the number of homes under construction here is close to an all-time high. And it's just, so that inventory is going to come on the market is now. The question I have, is that enough? And I don't know the answer to that. And I don't know if anyone knows the answer to that. But, there's a huge supply about ready to come on the market. Obviously, most of that is apartments and condos, but they will be rented out, and that will put some huge, negative price pressures on things when those homes are finally built.
That's very true, and I have heard from a number of different housing analysts that in what housing analyst Ivy Zelman calls the smile states, but they're really popular, high growth cities that we've seen over the past couple of years, the Phoenixes, the Austins, the Dallases, the Nashvilles. Builders, they go where the money is, and they've been building like crazy. There was a big monkey wrench that the pandemic threw into things for a while when people couldn't actually go to work, but now that's over. And so a lot of that inventory that was stalled is now also beginning to come on the market right now. So you're likely to see a bunch of new inventory, as you're saying, especially in these hot markets, popular markets, flood onto the markets right at the time where consumer demand is waning for all the other issues we've been talking about. So it's going to be another exacerbating issue to the downside. All right, well, so we've painted the picture for housing. That is likely, just to put a bow on it, that is likely to dampen consumer spending, right, if we have a major housing market correction, which is likely to then further squeeze corporate profit margins.
Manufacturers.
And now we're going to get to our topic where we might not see as eye to eye as we have in everything else, which is, all right, so companies that are squeezed then go into layoffs. So what's your outlook for the job market here?
I think we're going to start to see. First off, we got a jobs report tomorrow. Right, so that one's going to be.
We just got a bunch this week, which is basically showing a stronger slowdown.
ADP came out today.
And the jolts.
The thing about ADP is, and I've asked both of them and the BLS, and by the way, people malign the BLS. I've talked to them on probably a dozen occasions. These people are actually amazingly bright. They try and do their job. They're not trying to hide anything. They're not doing stuff because Biden tells them to do stuff or Trump told them to do stuff or whoever, to Obama or whoever. I mean, that's been the rumor for years, and I just disagree. Their hands are actually tied, and I asked them one time, and I said, why don't you just go through weed out duplicate Social Security numbers? And this person said to me, well, we'd like to do that. And I said, and they said, and we can't because we don't have access to the data. Say what? Yeah, these people putting out all of these reports don't have access to the jobs data. And the reason is all the Social Security numbers in the system are unencrypted, and they don't want to give people access to this thing. Well, I mean, this is just government stupidity here. and it's not because the people at the BLS don't want to have access to the data. I mean, this is just a sort merge program, for Christ's sakes. All you got to do is sort the data without even looking at it and just weed out duplicate social security numbers. How hard is this? But apparently it's so difficult that so the BLS goes in this birth death mode of nonsensical reporting. And by the way, that's not as bad as it's maintained to be either, except that it's really bad at turns. So, which means it's probably really bad right now.
Yeah.
So, anyway, so that aside, and now I forgot what your question was.
Your
So
outlook for jobs.
again. Oh, outlook for jobs. We've got 22 million, and this status from January, I really need to go update it. But as of the beginning of the year, there were 22 million people of age 60 and older that are still working. Okay, a fair number of them are going to retire. They're going to get buyout packages, whatever. We could have 10 million of them. 10 million of people in that age group retire, and it barely impacts the unemployment rate at all. And, it's because they're no longer they're not working, they're not employed. Employment drops by 10 million, right? But unemployment doesn't go up by 10 million. It might go up by 1 million. So, that's one thing. We still have a lot of openings, okay? And what happens before people are fired is we don't fill open position. Then what happens? Then what happens is we cut people's hours. So,
Hey,
people
can I ask you one question first, though?
Yeah.
And on how true that is. In other words, there's a criticism that says sort of in the modern era where multiple job sites, a job opening gets counted multiple times.
Man, I'm breaking up here for some reason. I don't know what happened to my cell phone. Can you still hear me? I'm moving around trying to find a spot where I can hear you and you can hear me. Is this good?
Good for me.
Okay, I can hear you. So I did. And no doubt some of that is going on, but all of a sudden are we saying that this is like 6 times as bad as it ever was before? I don't think so. If you just go around, looking at all the restaurants here that genuinely have openings, and I can tell you without a doubt service here at some of the restaurants in this area at least, and there's a danger in extrapolating your home conditions to something that's happening nationwide, but I believe it. Every time I travel, I see the same thing, help wanted ads. So that was no doubt exasperated by 2 different things. The free money handouts and rent eviction moratoriums. Some people, saved up that money for a really, long time. I think most of that has now been spent, but perhaps just within the past quarter or so. I think those job openings are really there. Even if you tell me that they're exaggerated by 2 times, that's still, dwarfs anything we've ever seen before. So that would be my answer.
This recording of my conversation with Mish over Twitter Spaces will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as the little bell icon right next to it. And be sure to hit the like button as well while you're down there. And if you'd like to catch the future discussions I have on Twitter Spaces when they happen live, be sure to follow me on Twitter. My handle there is @MenloBear. Finally, if the challenging macro outlook Mish and I have discussed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no-strings-attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks Mish and I have mentioned here. Just go to Wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of my Twitter Space discussion with Mish Shedlock.